All right, so thank you so much for taking the time to join us today. Tom and I are thrilled to have you for this webinar. Whether you're joining us from home, the office, or on the go, we truly appreciate your participation. As always, our goal is to keep you informed and well prepared in an environment that's consistently changing. Given the ever-changing market conditions we're seeing, we wanted to host this webinar to make sure you have the latest information to help guide your financial decisions. The markets can be unpredictable, and we believe it's important to stay proactive so you're well equipped to make decisions that align with your goals. Before we get started, I wanted to take a moment to thank each of you for your trust and partnership with us. It's a privilege to work with you, and we truly value the opportunity to guide you through these uncertain times. If you have any questions or concerns, or if you'd like to discuss your portfolio in more detail, please don't hesitate to reach out. Whether it's something as simple as a quick question or a deeper conversation about your financial strategy, we are here to support you. Your financial well-being is our top priority, and we want to ensure that you feel well informed and confident about your next steps. So today's session will cover some of the key developments in the market and how they may impact your financial plan. Bryce will be sharing insights and strategies to help navigate these changes. Then we'll open the meeting up to discussion with a brief Q&A session.
Do we introduce Bryce?
Yeah.
Okay. I'd like to take a second here to introduce Bryce. So this is Bryce Gill from First Trust of Chicago. And during the first couple minutes of conversation with Bryce, we learned that Bryce is getting married. When's your wedding actually, Bryce?
It's on June 7th.
June 7th, it's just a couple weeks away.
Yep.
Bryce lives currently in Austin, Texas, the beautiful city of Austin, Texas. And Bryce, as everybody could realize, has that nice Raleigh fingers look going on with the mustache thing. So I'm sure that's not the first. You probably heard that over 100 times, I'm sure, if not thousands of times at this point, with all the clients that we have that are slightly a little bit up in years. Everybody from my age remembers good old Raleigh fingers of the Oakland A's, if I recall. But anyway, Bryce is an economist. With First Trust economic team that Bloomberg has ranked as one of the top forecasters of the U.S. economy for several years. Bryce travels the United States presenting timely information on the economy and financial markets to both professional and everyday investors. He has an in-depth knowledge and understanding of the market trends and how they are shaping the financial landscape. And I know his insights will be valuable as we look at what's happening in the markets right now. Bryce, thanks so much for being here with us today. And so we'll have you give let's say maybe a 25 minute little overview of the market conditions. If anyone has any questions, you can either ask them or maybe we'll unmute everybody where you can type them into the comments, the comment section?
In our chat.
In our chat, or we'll open the mic up for maybe a couple minutes of questions there. So without further ado, Bryce, the floor is yours, and thank you so much for taking the time to join us, as well as everybody else out there listening as well. Thank you.
Yeah, well, absolutely. Thank you so much for having me, and it's great to be here with you. And yeah, I always hear Raleigh Fingers. I also hear like Doc Holliday from Tombstone, and who's the other one? What's like the guy that ties Lady to the train tracks in that cartoon? I always hear that one as well. Well, anyway, guys, listen. There's not a shortage of things to talk about, like in the markets and the economy, right? And we only have 20 minutes, which, by the way, I'm super glad we have 20 minutes. It's not like a 3-minute spot on the news where I couldn't really get in depth on anything for you, right? But I've been doing this 11 years as an economist, and I think about what I used to talk about on these presentations pre-COVID, and it seems so quaint in comparison to like a global pandemic, economic shutdowns, money printing, the highest inflation in 40 years, the Fed's hiking interest rates, they're cutting interest rates, the market's super volatile, geopolitics is going crazy, right? And then, hey, Donald Trump just got reelected. Since then, it's been like drinking from a fire hose, right? It's like new economic appointments, it's new policies, it's tariffs, right? We have the market crash, the market's rebounded. So there's like a lot to keep track of, guys. And I think, listen, at least to me, like one of the best parts about the modern world is access to information, right? We do have all the world's information at our fingertips, but it's a double-edged sword, right? It feels like you're drinking from a fire hose of information, and it's hard to sometimes like make sense of the noise, I feel like, especially with like big picture stuff, like what's happening with the US economy and everything else. So kind of what I wanted to do here today is just add some context to what's been going on with trade policy, tariffs, the market, talk a little bit about the US budget situation. And the reason I want to focus on those two things specifically is, one, we have limited time, right? And I kind of have to pick and choose. But two, I think those things are really relevant because they go towards interest rates, right? Interest rates are kind of heavily involved with both of those topics. When you talk about like what are my financial assets worth, or what's the stock market going to be, or is the market going to go up or the market's going to go down? There's kind of two empirical factors that drive the stock market. One is profits, is like, hey, the company's going to keep making more and more money, right? The other is going to be interest rates because that's the multiple or like the discount rate we use to value the market overall. And so I'll tell you guys right now, like I'm not worried about profits in the United States. I think the economy is going to grow this year, and we could talk about like risks of recession, and I will today. It's always been kind of my concern's always been interest rates. Okay, the bottom line is like after 08, 09 for a decade, we had 0% interest rates, and when money is free, like everything just goes up in value every year, right? It's kind of like easy street. Okay. Well, then COVID hits. We have the worst inflation in 40 years. The Fed hikes interest rates. Now all of a sudden, hey, that higher interest rate has made the market look, overvalued compared to like a 0% interest rate, right? So I think the relevant question is like, hey, will inflation get back to 2%? Will tariffs cause inflation? And like, will we fix the budget problems in the US? Because all those things are going to play into a lower interest rate that's more stable. And that's really what will give us, like, I think, a sustained growth in the market going forward. So with that, guys, with that kind of little introduction, I'll share some slides and we can get into it. I think these should pop up. And guys, let me know if these are showing up on your side. I just want to make sure people can see them before I get into it.
That's perfect, Bryce. We see him.
Okay, awesome. So, guys, I want to start with trade policy, all the crazy things that are happening with trade. And, obviously we had a big market correction happen, right? Over a 20% decline. And that sort of lined up with Donald Trump adding all these tariffs to the US economy. Now, since then, right, things have gotten scaled back. They've been kind of making some deals, maybe. The market's bounced back a lot. And so I'll go into detail on tariffs and like how much of an impact they can have on the US economy. But first, guys, I just want to set the stage on trade policy because I think this is kind of the most interesting thing going on in the world personally. And tariffs are not like the first big thing that's happened with trade, right? We've been seeing major thing happen with US supply chains and trade since COVID-19. And I like to tell people the past 30 years were the biggest boom in globalization in modern history, okay? Because what happened was the Soviet Union collapsed. So half the world basically joined the Western markets overnight. And then on top of that, China joins the WTO, the World Trade Organization, and they bring 1 billion people in their labor force with them, right? So like in a really big picture sense, the United States, we got access to a lot of cheap labor and materials in a really short period of time. And so if you're a business and you can cut your labor costs by 90% by moving a factory to China, one, if you don't do it, your competitors are going to do it. You're going to like go out of business, right? But two, like, hey, that's going to be good for your profits, obviously, but it's also going to be really good for domestic inflation in the United States, right? You can pass on all the cost savings from labor to the end consumers, which is all of us, right? And so I think one of the reasons that we've had like this low inflation rate at 2% for the past 30 years, and that became normal, at least in like the financial industry and kind of at the Federal Reserve, that's 2% is what they want to see. I think a lot of that was just cheap labor all over the world, keeping inflation low. Okay. The trade-off to all of that is, hey, you're going to deindustrialize as a country. You're going to stop making as much stuff for yourself. And your supply chains are going to get really long and complex. And they'll be efficient, right? That you can make things cheaply, but they're also really fragile now. And so when something like COVID comes along, it totally overturns the whole apple cart. Supply chains self-destruct basically. We have like the worst supply chain crisis since the OPEC oil embargo during COVID. And what you've seen in the aftermath of that is a huge political response by the United States to bring more production in-house, to make supply chains more resilient, especially in critical industries like semiconductors or green energy or pharmaceuticals or go down the list, right? And so a lot of this, I think, sounds like political rhetoric to people, but there's been major changes on supply chains in the past couple of years. So that's the chart that I have on the screen for everybody. this line just shows how many factories we're building in the United States at any given time. Okay. So you can see from like 1993 to 2022 for like 30 years, basically, construction spending on manufacturing, like how many factories we're building, basically trended sideways. Nothing really happened, right? That's because, hey, if you're building a factory, you're not building it in the United States, you're building it somewhere overseas. Well, then COVID hits. And by the way, I know like Donald Trump starts talking about this stuff in 2016, but you don't really see much happen until COVID because it doesn't matter who you voted for, right? Like nobody could buy toilet paper and baby formula. It sort of changes the status quo around supply chains. Everybody wants things in-house now. In the past 2 years, guys, we've seen factory construction in the United States triple. It's gone up more in 2 years than the past 30 years, right? We're working pretty hard in the United States to become more self-sufficient in certain critical industries. We are becoming more self-sufficient. It's not just political rhetoric. It's also very bipartisan, one of those bipartisan issues out there. But the trade-off to all of this is, hey, it's just going to be more expensive to pay Americans to make some of this stuff over the short term, right? And so reshoring, bringing all this business back home, bringing production back in-house, we don't have to worry as much about like China and Taiwan, right? But the trade-off is, hey, inflation's going to be a little bit higher, maybe baseline it's 3% instead of 2%. And that means the Federal Reserve's not going to be able to come to the rescue. They can't cut interest rates back to 0%. Free money is gone away for the time being. And that means investing's a little bit more difficult, right? You got to sort of pick and choose things better than in the past. And so, guys, I'm going to get into tariffs specifically here in a second. But before I do that, I just want to sort of reiterate, like, uh, outside of politics, like let's just take Republicans and Democrats out of this, okay? I think reshoring is going to continue in the United States for the foreseeable future. One is because it's bipartisan, okay? Both parties want it. But even setting that aside, okay? The whole reason we went abroad in the first place was for cheap labor, okay? All the cheap labor is going away. The populations are peaking and declining for the foreseeable future. The supply goes down, the price goes up. It doesn't make sense to make things in China anymore. On top of that, you've got all this AI and automation stuff that sounds like buzzwords for sure. But let's like assume, hey, we can actually build a highly automated factory. Well, then cheap labor just matters less and less and less, right? You might as well build that factory in the United States. And so, because of less cheap labor on the world, because of better technology, I think you're going to see the United States manufacturing sector have a huge renaissance here. I think we're going to start making a lot more stuff for ourselves, especially in more critical industries that have like strategic value. So with that, guys, all right, let's talk a little bit about tariffs. All right. So there's sort of two ways that you can go about incentivizing reshoring politically. All right. One is what we'd call industrial policy. That's like the CHIPS Act and the Inflation Reduction Act. The government spends trillions of dollars to, basically incentivize companies to make things in the United States. And that works. Like I think this chart shows that it's helped out. Okay. The only problem is we have a big budget problem in the United States, and we can't really afford to keep throwing trillions of dollars at this problem. And so that leaves us with tariffs, right? Tariffs are a blunt instrument. They're not like a scalpel, right? They're a hammer. But what tariffs do really well is one, they're just kind of across the board, right? You're not like picking and choosing certain industries. But two, tariffs, instead of having to pay money to bring business back into the United States, the federal government actually collects revenue off of tariffs, right? So just like, and I'm going to go into the details on tariffs in a second here, but just from like a real politic perspective, right? And like a budget perspective, you're going to see tariffs stick around because, they help the federal government collect revenue instead of sending revenue out the door, right? It's not going to fix the budget problem, but it certainly doesn't make it worse. And you actually incentivize reshoring at the same time. So with that, all right, let's talk about tariff rates really quick. All right, guys. So I have a chart now. It's the past, it's the entire history of the United States, basically, back to 1790 tariff rates in the US. Okay. And I wish we had more time. I talk more in detail about this chart. I think it's a pretty interesting chart. But I want you to focus on like that last little blip there. You can see how much it shot up in a short period of time. Okay. We had this big market correction, and there was a lot of talk about recession from tariffs, right? And a lot of people are talking about, hey, the last time tariff rates are this high, it was the lead up to the Great Depression. Okay, and that is objectively true. You can see that from this chart here, right? We have not seen tariff rates this high since 1929, which is when the Great Depression basically started. Um, all that being said, okay, the United States economy is very different today than it was in the 1920s. All right, if you think back to that period of time, we were a major manufacturing and export-based economy. We were kind of like China or Germany are today. And especially, leading up to World War I and through World War I, the United States became like the factory for the entire Allied powers in World War I, right? We're exporting trucks and bombs and bullets and uniforms and medicine over there. We had all these factories built for that purpose. Well, then the war ends. Nobody wants to buy that stuff anymore. Countries want to kind of make more things for themselves. They just went through a world war. Global trade starts to fall apart. The country that's going to hurt the worst is the big seller of stuff, right? The big exporter. That was the United States at that period of time. So you can see how, like, hey, trade falls apart. It helps exacerbate the Great Depression, right? Tariff rates help cause global trade to fall apart more, but global trade was already declining. Today in the United States, guys, we're not a major manufacturing and export economy anymore. All right. We're essentially a consumer spending economy. We're the buyer of everything today. Okay. And there's a lot of talk about self-sufficiency in supply chains in the United States, right? Like semiconductors or pharmaceuticals. And certain like parts of the supply chain, there are problems with self-sufficiency, right? And I'm glad those are being addressed. But when we talk about the overall US economy, like the economic pie, the GDP, okay, the United States is one of the most self-sufficient economies on the entire planet. And the reason why is that consumer spending is 70% of GDP. And when you look at consumer spending in the United States, the vast majority of it is what we call services. Okay. And so, what is a service? A service is me doing an economics presentation for you guys. It's golden strategies helping you guys out with your financial investment needs. It's getting a haircut. It's going on vacation. It's going out to eat, right? 70% of what we spend money on is services in the United States, and services are provided by Americans to other Americans locally and domestically for the most part. Okay. And so services are not touched by tariffs directly. You tariff whatever Chinese goods, the service sector doesn't really get impacted. And that's the vast majority of the US economy is just services. Okay. The other 30% of consumer spending is goods. But the United States actually produces two-thirds of the goods that it consumes, right? So you're talking at the end of the day, about 10% of consumer spending in the US is actually imported goods. Okay, so it's a pretty small overall chunk of the economic pie at the end of the day. It's a lot smaller than I think people think. And when you dig down even deeper, guys, it really matters where the stuff is coming from. Okay, and I think we have this perception in the United States that everything's made in China. But that really started to change back in 2018 during the first trade war with China. Okay. Chinese imports as a percent of total US imports have been falling since 2018. Today they're about 12%, 13% of total US imports. So, almost 90% of our imports of goods come from other places in the world besides China in the United States. Canada and Mexico here in North America are our biggest trading partners. Everybody's heard about these like 25% tariffs on Canada and Mexico. The reality is like the vast majority of stuff that we're importing from those countries is duty free. It's not being tariffed at all today because of the USMCA agreement. Like 85% of what we buy from them is not being tariffed. So if you go to Whole Foods and you go to buy an avocado from Mexico, that's 100% made in North America. It's not being tariffed at all, right? It's like if China would import a bunch of synthetic fabric into Mexico and Mexico turns that into blinds for your house, that would be tariffed possibly at 25%. So most of the stuff in North America, our biggest trading partner is not being tariffed at all. It's 0% tariff rate. Things are paused, things are in flux, right? There's all these negotiations going on. I think the biggest one people are worried about, guys, is China, right? We had 150% tariff rate on them. I know now it's like 30%. We're on like a 90-day pause. I'm not going to sit here and speculate what's going to happen in trade negotiations, guys. I don't think I can add any value there. All I want to point out is like, if US imports of goods are 10% of consumer spending and China is like 12% of imports into the United States, well, 12% of 10% is 1.2%, right? Imports of Chinese goods are 1.2% of US consumer spending. I don't think most people have that context, right? Like that giant tariff rate, even if it stayed in place, it's only hitting 1.2% of consumer spending. I'm not here to tell you guys tariffs are great. I'm not here to tell you there's not a better way to roll all this out that's less chaotic, right? I'm just saying, hey, like the actual economic impact of this stuff is pretty small in reality, right? Um, the way that a lot of, when you look at like other investment banks or economists who disagree with me, right, are getting to this idea that, hey, a trade and tariff policy can cause a recession is that it creates uncertainty, right? Policy is now uncertain. Businesses don't know what's going to happen with the tariff rate between China and the United States or US and Peru or whatever. And so they're going to pull back on investment until they have more certainty, right? And you pull back on investment, you hire less people, the economy slows down. And I understand the rationality behind those estimates, right? I get what they're arguing. In theory, it makes total sense, right? But theory is only good if it lines up with reality. Okay. And I think when we look out there in the world today, the reality is that we're seeing a ton of investment happen in the United States. Okay. The past 2 years, factory construction has tripled. There's like $2 or $3 trillion of committed investment into the United States from all over the world right now over the next 10 years. You're seeing major multinational corporations on like a daily or weekly basis come out and say, we're investing 5 billion or 10 billion or 20 billion dollars to build a factory in the US. And the reason why is we're the biggest buyers of everything. If you're a multinational corporation, you need to be able to sell to the United States. We're like 50% of your addressable market. And so if you what you have to do is build a factory to make pharmaceuticals here in order to sell those pharmaceuticals to the United States, that's basically what you're going to do, right? And so guys, I don't see business investment slowing down in the United States at all. Q1 GDP, there was like a 20% increase in business investment in like one quarter, right? That's a huge number. And so, we haven't seen the labor market slow down. We haven't seen a spike in inflation. Trade guys, we're just not that trade dependent as a country. Like we really are self-sufficient from a GDP perspective. It's because mostly what we buy is just stuff from other Americans, right? And you know, I would guess, given our like leverage as the biggest consumer market, we'll be able to figure out some deals. But I think the trade deals, honestly, my personal opinion is I don't think they're as important as people believe they are. I think it's more about us making more things for ourselves. I think that's kind of the big push that we're going to see. So, guys, I find it very hard to see how trade, like tariffs, get us to a recession. I understand the theory that people are putting forward, but the theory doesn't fit with reality, with the data right now. And it looks like the opposite. It looks like a huge amount of investment is coming into the United States. So,
Hey, Bryce, we have a quick question. So, Jen, that's a good question. So, we have someone that asked, so along with the tariffs, so if the large amount of trade exemptions for the tariffs, so if only 10% of the consumer products are imported in this context, then why is the market, do you think, reacting so severely?
yeah, it's a great question. So, I think it's all about uncertainty. Okay. The market does not like uncertainty at all. I think the reality, guys, is that we came into 2025 overvalued in the stock market because interest rates are high, as I mentioned, right? Things are basically priced to perfection, is what we would call it. Okay. The past 2 years, what's happened is this narrative around AI and automation, which, to be fair, I do think these technologies will mature and become a big part of daily life in the United States. But it's been mostly a narrative about how this is changing the world. It's the fifth industrial revolution, and you just need to buy, and like valuation doesn't matter. And so what happened was seven stocks drove the entire stock market for 2 years. That's unsustainable. You look at any kind of like back test of the market, anytime that happens, it leads to a correction. And so I think we were just overvalued headed into 2025. I think the market was priced to perfection. And so when Donald Trump comes in here like a wrecking ball of uncertainty, which is what he does, all of a sudden that like Goldilocks like scenario for the future disappears, chaos sort of enters, and the market corrects to a more normal valuation. So I think it was all about interest rates and kind of like came into the year just overvalued, and certainly tariffs added to uncertainty, but just from a real economic evaluation of like how much an impact tariffs can have in the United States, it's not 1929. I mean, we're just not an export-based economy. The countries historically, if you study it, that get hurt the worst in trade wars are the export countries because they have all the factories and the capacity built up to make everything, right? If all of a sudden the customer goes away, you're left holding the bag of like billions and billions of dollars of capex. So we can make everything in the United States, right? Maybe we have to make more automated factories or whatever, but we'll figure it out over here. And by the way, like again, the globalization is going to reverse because the cheap labor is going away. Automation makes cheap labor less valuable anyway as a comparative advantage. So, guys, I think we have a lot of positive things on the horizon in the United States, but certainly the stock market was just, it was overvalued. I'm 2 years of seven stocks driving everything's unsustainable.
Very cool. Bryce, a question. So, I love the fact that you mentioned what First Trust has, what, 7, 8, 9 economists on the team, headed by Brian and Bob as well. And you mentioned that everybody is encouraged to have, all the economists are encouraged to have their own opinions. And there might be disagreements. Bring your own case, make your case against, which I think is wonderful. I know that at the beginning of the year, obviously, there were forecasts of all the major banks and financial institutions such as First Trust giving where they think the S&P might end up at the end of the year. And there were some that were, real optimistic. There was a lot more that are more concerned or more pessimistic. And I know the First Trust was, I think, fell into the latter part of that camp where they're a lot more conservative. Have things changed a little bit? I can't remember if your S&P was maybe flat or slightly negative. You weren't real optimistic or positive on the economy and on the markets. Has that changed a little bit in your opinion, or where do you stand? Where does First Trust and yourself stand right now?
Yeah, so thank you for asking. And guys, I mentioned like, hey, I think the market, we came in at 25 overvalued. I'm not saying that with like just a rear view mirror. A lot of people will do that. They're like, hey, we revised our forecast down after the market already crashed, right? We came into 2025 saying the S&P 500 year-end target was 5,200. Okay, so the market actually fell more than that. It fell more than we were expecting, faster than we were expecting, but we're the only major bank on Wall Street that was calling for a correction. Everybody else thought the market was going up in 2025. So, and maybe it still will, right? We have a lot more of the year left. But again, guys, I mean, Donald Trump is his brand is uncertainty, right? So I'm guessing we'll see more and more chaos going forward. And like, yes, if everything's perfect and everything's stable and the status quo exists, like maybe the market can have a positive year. But I would just say like interest rates it's like 4.5% interest rate right now. That's where it was at the start of the year. The Fed can't really cut. They can't bail us out. Inflation's still too high. And so unless the interest rate situation changes, I think the market's basically going to trade sideways this year. I don't think we're going to be at a new record high by the end of 2025, is what I would say, right? And the biggest thing that we could do, okay, like reshoring, I think is going to keep inflation above 2%. So the Fed can't really step in and help us there. And I don't think tariffs can cause a recession, giving the Fed an excuse to cut, even though inflation's high, right? So the Fed's out of it. And so basically what we're left with here is like the US debt situation, okay? Another reason interest rates are high is that investors all over the world look at the US budget and debt situation and they say, hey, this looks unsustainable. And if it's not addressed, like I'm at risk of losing money. And so I want a higher interest rate if I'm going to lend to the US government. Okay. And so the chart I have on the screen here, guys, this is just the federal interest cost as a percent of GDP. So what percent of overall economy in the United States a year do we spend on interest? Okay, and you can see historically kind of what it's been. So it fell for 30 years, COVID hit, inflation spiked, the Fed hiked interest rates. We're not like a record high level of interest payments, and it's going higher from here, right? So what was the big story over the weekend? It's that Moody's, which is the big credit rating agency, downgraded the US debt. They basically were like, hey, you guys are spending way too much money. You haven't addressed spending really. There's no real plan here. And now you want to like extend tax cuts and everything else. That just makes everything more unsustainable. So we're downgrading your debt. It's a bigger risk, right? That's kind of the bottom line. And so, guys, if we want interest rates to come down, we basically need to address government spending. Okay. And there's obviously like Department of Government Efficiency, like DOGE, right? That's been like a big story. And there's like interesting tidbits that have come out of that. But like the reality is they haven't, Doge can't cut spending. They can like pause some contracts and whatever, but they're like a think tank, basically. They can recommend what to do to Congress and the president and the OMB, but they can't really cut spending. That's going to be up to the president and up to Congress to do that. Um, and guys, like, there's a giant omnibus bill, like the budget and like the spending bill and everything else going through Congress right now. They're all like kind of fighting over it. Okay, and from what I see, there's not really any spending cuts happening yet, right? I mean, they're talking about cutting some discretionary spending. There's maybe some more tariff revenue coming in. Maybe that pays for the Donald Trump tax cuts being extended, right? But the best estimates I've seen is that like after they pass this bill as it currently stands, the deficit over the next 10 years is actually a little bit higher. It's not lower, right? So that's why Moody's is downgrading the debt, right? Um, how could we cut spending? Well, you've got a lot of different areas that are not Social Security, Medicare, Medicaid that you could cut spending. Defense is a major one, right? If Europe's going to pick up more of its own defense, like why are we spending even more money than we did 2 years ago? It doesn't make sense, right? COVID spending never went away. We can cut some of that. You've got Republicans right now in Congress arguing. I live in Texas, right? Republicans in Texas want to keep all the wind and solar and electric vehicle credits in the Inflation Reduction Act that Joe Biden passed. Why? Because we have more wind power here than any other state in the country. They want the money to keep flowing, right? So I think it's all about cutting spending, guys. That's kind of what we need to see to get lower interest rates. If they keep kicking the can down the road, what's going to happen is all of a sudden interest rates are going to be at 5%. Then they're going to be at 6%. Then they're going to be at 7%. And they're just going to go higher and higher and higher. And like, if you don't like, it's like 7% mortgage rates now, imagine 10% mortgage rates again. That's the situation if the government doesn't have some self-control and actually cut some spending. We're at a point where things can get better very quickly, I think, or worse very quickly. And I hope they follow through on spending cuts. Like we actually need to cut the deficit and address the issue here. Otherwise, the stock market basically is going to go nowhere. It's going to be fighting higher and higher interest rates, even though profits are going up, which is basically a recipe for things to trend sideways. The last thing I'll say, guys, before we end it, we can do some Q&A, is I've talked a lot about spending, guys. Why have I not talked about revenue? Why not just raise taxes? Okay. One reason is that Donald Trump's not going to raise taxes. He wants to extend his tax cuts, right? So I don't think he's going to raise any taxes. But number two is, okay, I think the debate around raising taxes on the rich in the United States is a waste of breath. I think it's honestly like the political version of like professional wrestling. Okay, it just doesn't really matter that much. And the reason why is like, the top marginal income tax rate, what we're fighting over, we're really like talking about taxing your like doctor or your orthodontist or like, the local small business owner more. You're not really talking about like, hey, the hedge fund guy or the billionaire guy being taxed more. And so if you look at the history here, and I'll walk you guys through this slide in a second, what you see is like top marginal income tax rates don't really matter that much for revenue collection. Okay, so the blue line here is the top marginal income tax rate in the United States. I don't think most people know, like in the 50s, that was at 92%. We taxed marginal income at 92% in the US under a Republican government, by the way. That was Dwight Eisenhower. Okay. Now, do you guys think anybody was paying 92% taxes? Like, no, right? You had a good accountant or a good lawyer, you ran it all through your business. I like to tell people like the biggest band in the world at that time was the Beach Boys, right? What are the Beach Boys singing about? They're singing about Aruba, Jamaica, Bermuda, Bahama, right? It's because everybody was funneling their money into the Caribbean to avoid taxes into the United States, right? We're building all these like resorts and everything. It was like a way to avoid taxes. Okay. Over the years, you see JFK cut tax rates, then you see Ronald Reagan famously cut tax rates. Today, income tax rates are 2/3 lower. Okay. And so, like Kamala Harris, let's just use her as an example, right? Recent presidential election. She's talking about raising the top personal income tax rate to like, let's say like 42 or 45%. Okay. That puts us back to where we were in, 1984. All right. If you just look at the orange line now, okay, the orange line on this chart is the federal government revenue. So how much taxes does the federal government collect as a percent of the overall economy? And what you see is basically the whole time it's collected between 16% and 19% of GDP. There's like a carrying capacity of the US economy to generate revenue for the federal government. And so maybe you have a keener eye than I do, but there's no correlation between top marginal income tax rates and like actual revenue collection. It's mostly like just, again, it's like a political sideshow. It's just a way to distract people. I feel like marginal income tax rates don't matter that much. Okay. If we spend over 19% of GDP at the federal level, we're going to run a deficit. It doesn't matter what tax rates are. And so, guys, we have a spending problem in the United States, not a revenue problem. If we collect another $100 billion in revenue, what we do is we spend another $300 billion. And so it actually doesn't matter how much revenue you're collecting unless you control the spending side of things. So I really think that's the biggest challenge they're going to have. Like the federal government's going to fight back at every level about cutting spending. Okay, but it's starting to basically drown the economy, the amount of federal spending that's happening. It's pushing up interest rates. It's going to make people's investments trend sideways unless they actually cut spending. The downside to all of this, guys, while I cannot see tariffs and trade causing a recession in the United States, hard to see how that happens, just like mathematically. I could absolutely see a big cut to the federal government budget in a short period of time. Say they cut $1 trillion. Like that would be, I don't, that would be a dream come true if they could do that. That puts us back to like pre-COVID levels of spending, right? Which the pandemic's over. Why is spending still so high? That's another maybe question we should be asking, right? Just back to pre-COVID levels of spending, that's $1 trillion in spending cuts, okay? If you did that, short term, that could probably cause a recession in the United States, right? As we reallocate all those resources, but it also lowers interest rates. It also makes the market more sustainable. It also gets us out of this like, early stages of like this debt spiral that's happening. So I think that's like the biggest thing I want to see from this administration, actually follow through on some spending cuts. If they just ram through tax cuts and blow out the deficit even more and kick the can down the road, we're just going to see interest rates climb higher and higher and higher. That's kind of my personal opinion. So I'll go ahead and end it there. I'm sure I've already been talking for like 25 minutes. Sorry for keeping people a little bit extra. But if we have any questions, I'll be happy to hang out. Really appreciate you guys spending some of your afternoon with me. And yeah, let's turn it over to the audience if anybody has something.
Fantastic. Thank you so much, Bryce. That was exceptional. It was really, really helpful. Thank you so much to you and to First Trust as well. As a quick reminder to everyone on the Zoom, if you want to enter your question into the chat, just select the chat feature at the bottom and you can type your question there. Or you could simply just ask the question if you'd like as well. You'll just, a little reminder, make sure you hit the microphone down at the bottom left of your screen to unmute yourself. And then once you're done asking the question, please put yourself back on mute. And then if you have any personal questions, you're welcome to email us, give us a call, set up a meeting, or just discuss over the phone. We're very happy to do that as well. Thanks again, Bryce. That was great.
Does anyone have any questions? But unmute or raise your hand or whatever.
I think we have one here from Jennifer. Jen, you mentioned you were going to address recession in general.
Yeah, so I think from tariffs, very low likelihood of a recession, okay? I don't see a tariff-induced recession happening or like a trade policy-induced recession. I think globalization is just reversing, guys. That's going to happen no matter who's president, and business coming back to the United States. And so I just think trade policy is kind of like it's important a little bit, but it's not big enough to affect the U.S. overall economy in the way that could cause a recession, in my opinion. What could cause a recession is big spending cuts. And so that's why I mentioned like that's kind of what I'm the most focused on, is what happens with this like omnibus bill budget. Currently, as it's structured, right, like the New Jersey and New York Republicans don't want to vote for it unless they expand the SALT deduction, right? Which if you expand the SALT deduction, basically it reverses all the revenue raising portions of the original Trump tax cuts, right? So that's immediately like massively blowing out the deficit. On top of that, you've got a bunch of Republicans from like Texas and Oklahoma that don't want to reverse like the wind and solar credits. And so like this is like trillions of dollars of revenue that like Republicans don't want to get rid of, right? Or don't want to actually make hard choices on. So basically what's going to take is like Donald Trump using his political heft to like browbeat these guys into going along, which in this case I would be in support of, right? I think we need to cut some spending. We need to get the deficit lower because otherwise the government spending problem is just going to spiral. It's going to get worse and worse and worse and harder to address. But that's what could actually cause a recession is short term, they follow through on some spending cuts.
All right, so you're saying to lower the interest rates, they cut spending, and a recession is a necessary evil then.
I basically think that's where the point that we're at, right? Is like it's either short term, like you have a minor recession from cutting government spending, or long term, there's a debt spiral and we have to cut government spending or the economy slows down even more dramatically. Like I don't think there's a way out necessarily without some kind of adjustment, is how I'd say it, right? Like I'm like in support, like I get it. We had the COVID pandemic. It was 100-year emergency. Like we had to turn on the cash gushers, right? We had to do something about it. The problem is like the government spending just never went back to normal. And so today, like the deficit, if you look at like how much money we're spending more than what we take in as a percent of GDP in the United States, we have the highest deficit outside of like a war or financial crisis in US history. Like the unemployment rate's 4%. And we're spending like we're in like a massive crisis. We're in the middle of like the Vietnam War, for example. Okay, we're in like a massive conflict. The deficit was lower as a percent of GDP during the Vietnam War than it is today. And back then we had like 8% unemployment rate. We had a giant war going on. We had inflation, right? Today it's a 4% unemployment rate. Like why are we spending so much money? There's not even like even if you're and like guys like I'm a more of a free market guy and like ideology or sort of like I'm more inclined in that direction, okay? But like, just theoretically speaking, if you're like a Keynesian or like more of like a government solution person, there's not even like a theoretical argument for what we're doing today, right? We're not in a crisis by any means, so they shouldn't be spending so much money. That's the problem. Like, they start spending money and then it's impossible to get it back to normal again. It just becomes like part of the baseline. And guys, like if you look at the federal government today, okay, I'm not against like roads. I'm not against like the airports being renovated. I'm not against like a good court system or like a healthy defense, department or whatever. Like the federal government spending as a percent of GDP is 25%. So like one out of every $4 in the United States that's spent comes from the federal government. It's huge. You add in like state and local government and then like regulation, like 50% of GDP in the United States is controlled by government at some level, right? So I'm not anti-government. I'm not like an anarchist, but I just think we're at a point where like things are crazy, like, and they need to be addressed.
Well, and I think a point here to mention is these are part of the normal cycles of the market, mild recessions. I mean, and that kind of leads us towards briefly is the idea of diversification. And part of that diversification is international. I mean, we've all, we've read and we've heard, hey, now is time to diversify a little bit more outside of the country and international, which did better than the U.S. last year. And it's all part of a nice, well-diversified, broad portfolio. You want to comment on that a little bit as well?
Yeah, I mean, I believe in like diversification. I think, maybe some portion of your portfolio should be international. I don't know what like the industry standard weighting would be on international, but like, I don't know, my personal opinion is like, I'm one of the most anti-international investing people probably at First Trust. I just look out there, guys, and I'm like, everybody's making the case for Europe, and Europe's outperformed us like recently, right? Europe, the case has been made to buy Europe for the past 15 years, and they never outperform very long, right? So I'm kind of skeptical of the idea, like, hey, they're getting their act together. They're gonna, start paying for their own defense, and they're gonna, become more efficient, and they're gonna become more innovative and stuff. I love Europe, right? We were just talking about Europe. I'm going on vacation in Europe in August. But like the reality is Europe's kind of an open air museum, right? Like that's their entire economy is like stuff that got built 1,000 years ago, like beautiful geography and tourism. And then in the north, it's like manufacturing in Germany, right? Which is just fed by cheap natural gas from Russia. That's gone, right? The pipeline got blown up. And then on top of it, it's like, hey, they have this artificially low exchange rate in Germany because they're tied to like Spain and Portugal and Greece and everybody else. So that makes exports from Germany artificially cheap for the rest of the world. And so like, I don't know, tourism is not going away. Europe's going to do great there. Like they sort of sell like a luxury like brand to the world. That's like Europe's economy. The manufacturing part of it's in huge trouble though. Like Germany, companies are closing, they're deindustrializing. Like a lot of companies are moving to the United States from Germany because we have cheaper energy. Like it's just a better place to be. And by the way, now we're going to tariff everything that Germany does. Like, they don't buy anything from us, but we buy everything from them. That arrangement was created after World War II to help build up the economies after it was destroyed, right? And so it's been 80 years. Like Germany's a rich country. So I think in a lot of places, Europe's in trouble. China, I wouldn't touch China with like a 40-foot pole. Do not invest in China. Your money you'll be the first one expropriated as a foreign investor. China's also has a population collapse and like 0809 on steroids happening right now with their Evergrande real estate collapse. South America maybe looks good, like Poland maybe looks good, India looks good. Mexico, like North America is probably fine. Like there's pockets, right? But I think the problem is you go and you buy like an MCSI World Index. So most people are going to do. It's like 50% China in there, and that's just garbage. Do not buy that, right? Like maybe get something equal weighted or there's different indices that like they screen out countries that have different values, right? Like I'm thinking of like the Freedom Index, right? Which is a lot of countries ex-China, basically. So I just think it's hard to invest internationally. I don't see like a lot of fundamental value. It's like their demographics are bad, their innovation's bad. Here in the United States, we have the best demographics of any advanced country. We have the best innovation. We've got our problems, but we're by far the best operation going. So
Exactly.
I don't know. That's kind of some of my thoughts, I guess.
Yeah, that's good. Hey, this has been wonderful. I think it's time to wind it down a little bit. This is wonderful. Bryce, cannot thank you enough. And again, thank everybody for the trust that you put in us and working with us. And we put a lot of trust in with First Trust as well. So we'd like to continue these webinars in the future. So for those of you listening out there, whether it's on the recording or live right now, give us some of your feedback. What topics you would like to see in future webinars as well, whether it's Medicare, Social Security, anything more specific. We'll take that to heart and see if we can arrange those and put those together for you. Any other final questions, brief questions anybody has? No? Okay. Listen, thank you so much for joining. Bryce, thank you so much. And congratulations on your upcoming June 7th wedding.
Thank you so much, guys. Yeah, and let's do it again sometime soon.
Okay, sounds good. Thank you, everybody. Take care. Have a wonderful day.
Thank you.
Thank you, Bryce.
Bye-bye.
Bye-bye.